Have you all noticed a phenomenon recently? When you go to the bank to deposit money, the staff rarely recommend financial products to you anymore. In the past, when you deposited money at the bank, the staff would introduce you to many financial products. But now, why have they stopped recommending them? It's because most financial products have been taken off the shelves. Actually, these financial products are all made by the bank's own subsidiaries, and their safety ratings are quite high. In the past, banks relied on these products to attract deposits and make profits. But why have they suddenly been taken off the shelves? The reason is simple. They used to make money before, but now they're not making money, and some are even losing money. If a product is losing money, why sell it? This is closely related to the real estate market, because most financial products essentially rely on real estate. Once the real estate market loses its profitability, all these castles built in the air will collapse. With society unable to find ways to make money, facing an asset shortage, banks can only continue to lose money. Moreover, it's foreseeable that interest rates will continue to decrease. The high-interest products offered by banks before are declining, and it's difficult for banks' current profitability to support investors' financial returns. So the banks have laid their cards on the table saying, "I'm not doing it anymore. I'm not playing anymore. I'm going flat." Interesting, isn't it?
China's economy is deteriorating, the real estate crisis is severe, and the banking industry is deeply affected. Recently, many banks have suddenly terminated a large number of financial products ahead of schedule, attracting widespread attention from the public. According to incomplete statistics, as of June, more than 20 financial products have already been terminated prematurely. In the coming weeks, several more products will be terminated early, a phenomenon affecting major financial corporations. China Post Global announced on June 11th that its Postal Savings Wealth Wisdom Hongyun Customization No. 6 RMB financial product is scheduled to be terminated early on June 17, 2024, whereas its original maturity date was June 17, 2029. Prior to China Post Global, Mingsheng Bank announced on June 4th the premature termination of its Yuju fixed income class 2-year closed 150th financial product effective June 11th. China Construction Bank also announced the premature termination of its CCB Wealth Management Stable Bay Area Value Investment 1-year regular open second financial product on June 21st and another financial product to be terminated on July 12th. Among the prematurely withdrawn financial products, some had been established for only over a month. Huaxia Wealth Management announced in June the premature termination of 2 financial products, both established in April this year. Just this past May, both products also announced rate discounts, adjusting the annual fixed management fee to 0.15%. Since the beginning of this year, almost every trading day has seen announcements of several products being terminated prematurely. According to data from Puyi Standard, as of June 13th, there have been a total of 1,053 net value type financial products terminated prematurely this year, compared to 878 during the same period last year, an increase of 175, or almost 20%. Other data shows that in 2023, more than 2,000 financial products were terminated prematurely, most of which were fixed income products. A financial manager at a commercial bank, Zhang Ping, explained that the so-called premature termination of financial products refers to the phenomenon where some fixed-term financial products terminate their contracts before the agreed term expires, or some indefinite-term financial products no longer continue to perform their contracts and are liquidated prematurely. According to mainland media reports, the premature termination of financial products by banks has sparked consumer dissatisfaction. Ms. Wang said that sometimes, if you don't notice the text messages, the funds that are terminated early may not yield any profits. After discovering this, one has to rearrange the funds, which is very troublesome. A financial planner in Jinan, Li Na, stated that the premature termination of financial products significantly impacts investors. On one hand, it may mean investors cannot obtain expected returns and could reduce losses from underperforming financial products. On the other hand, if investors haven't arranged alternative financial plans, the refunded funds may lay idle in their accounts, generating no profit. According to Li Na, an increasing number of premature terminations could affect consumer confidence in financial products. Banks' financial management companies need to continually enhance their investment research capabilities. cultivate investment research talents, and improve risk management levels. They should enhance their understanding of macroeconomic situations and financial markets, adjust and optimize asset allocations and investment strategies promptly based on market and client changes, and optimize product structures. For investors, before purchasing financial products, they should consider their financial status, risk tolerance, expected income, liquidity needs, and understand the contract to invest rationally. The Reizhi Xinghong Financial Research Institute stated that aside from structural and target profit products, premature terminations of most financial products leave investors with a negative experience, disrupting their investment plans and requiring them to spend additional time selecting products. It also reflects operational and investment research capability issues among managers, leading to unsustainable product operations. These financial products are all issued by state-owned subsidiaries, with banks originally relying on these products to attract funds. Why terminate them prematurely? According to a banking professional named Xiao Deng, the fundamental reason banks are quitting is due to declining interest rates. Xiao Deng explained, bank financial management generally invests in fixed deposits, large certificates of deposit, bonds, etc. During a period of declining interest rates, the yields of these products also decrease. Currently, high-yield products like large certificates of deposit are being taken off the shelves. In this situation, the originally expected high returns cannot be achieved, so it's more responsible to terminate the products early and withdraw, which is better for customers. A banking insider told Chinese media that over the past 2 years, macroeconomic conditions and market fluctuation have caused many financial products' performances to deviate from expected returns. Unexpected events exceeding market expectations could also affect the holding returns of financial products, prompting early terminations. In this context, products that shrink in scale and sustain miniaturized shares could also be terminated early by financial institutions. Analysis also points out that China's economic slowdown and the real estate market's downturn have severely impacted China's financial system, posing significant challenges to the banking industry. Therefore, the premature termination of financial products has emerged as a precaution against financial risks. Additionally, a banking professional candidly stated that frequent premature terminations began occurring after the fourth quarter of 2022. Moreover, Reuters reported on June 20th, cited 3 informed sources, that recently China's National Financial Supervisory Authority has issued a latest directive to small regional banks in provinces like Shandong, Guangdong, and Zhejiang, requiring them to reduce financial management business by the end of this year and completely stop selling financial products by the end of 2026, unless these banks have independent financial management subsidiaries. This new directive represents the latest measure by the Chinese Communist government to control risks in the vast banking wealth management industry. Over the past few years, this industry has been a target of regulatory crackdowns aimed at combating shadow banking activities. The latest directive also mandates small regional banks to standardize wealth management operations and invest funds in capital markets in a compliant manner. Additionally, it requires banks to clearly separate wealth management operations from other business activities to eliminate any implicit guarantees should these investment products perform poorly and require bank intervention. However, specifics of this new directive have not been publicly disclosed. The China Banking and Insurance Regulatory Commission, CBIRC, introduced the Commercial Bank Wealth Management Business Supervision and Management Measures and the Commercial Bank Wealth Management Subsidiary Management Measures in 2018, requiring banks to establish subsidiaries dedicated to wealth management operations. However, no specific timetable was set for banks to comply. Since the introduction of these regulations in 2018, major state-owned banks and large national commercial banks in China have established independent wealth management subsidiaries. However, most small local banks have yet to follow suit. The expectation of continued low interest rates has been widespread, and recent actions by some small and medium-sized Chinese banks to continuously lower deposit rates seem to confirm this trend. For instance, on June 4th, Lanzhou Rural Commercial Bank reduced its 3-year fixed deposit rate from 2.7% to 2.6%. Just the day before, Gansu Bank had already lowered its 3-year fixed deposit rate from 3% to 2.6%, marking a significant 40 basis point decrease, the largest reduction in this round of rate cuts. Furthermore, on June 1st, Chenghai Rural Commercial Bank in Guangdong, Pingle Rural Cooperative Bank in Guangxi, and Fuchuan Rural Commercial Bank also lowered their 3-year fixed deposit rates to 2.2%, 2.8%, and 2.8% respectively. After multiple interest rate cuts over the past 2 years, fixed deposit rates above 3% have become scarce. The trend of interest rate cuts is far from over. In the first quarter of this year, the net interest margin for commercial banks was 1.54%, down 15 basis points from 1.69% in the fourth quarter of 2023, hitting another historic low. Net profit growth rates also dropped from 3.2% in 2023 to 0.7%, a decrease of 2.5 percentage points. Among them, state-owned and private banks saw the most significant declines in net interest margins, with ICBC, Agricultural Bank of China, and Bank of Communications all having net interest margins below the industry average. Therefore, to maintain profits, commercial banks must continue lowering deposit rates. Additionally, on June 14th, the People's Bank of China released financial data for May, showing that the broad money supply, M2, was 301 trillion yuan at the end of May, a year-on-year increase of 7%, marking the lowest growth rate on record. Narrow money, M1 balance, was 64 trillion yuan, a year-on-year decrease of 4.2%, marking the second consecutive month of negative growth, a first in recorded history. Analysis indicates that these grim statistics reflect weak willingness among enterprises and individuals to borrow, with businesses lacking expansion drive and economic vitality remaining subdued. To stimulate economic growth, further reductions in loan interest rates are necessary. The current phenomenon is that even with deposit rates near zero, people still prefer to keep their money in banks. However, widespread saving without spending has frozen monetary circulation. As a result, no matter how much money the central bank prints, both businesses and households use it to repay debts rather than for consumption and investment. Furthermore, the trend of early repayment of mortgages is intensifying. In April this year, the prepayment rate of residential mortgages reached a historic high of 37%. Analysts believe that as a result, whether it's deposit rates or loan rates, the public generally expects further declines in the future. Banks continuously withdrawing high-interest deposit products and high-yield wealth management products are preparing for the arrival of a low-interest rate era. Perhaps an era where nothing earns profit is truly approaching. The Chinese economy is deteriorating, financial risks are increasing, and banks and other institutions are under tremendous pressure. According to media reports, China's banking industry is undergoing an unprecedented reshuffle. Within a 7-day period, ending June 21st, 40 rural, small, and medium-sized banks have been absorbed, merged, or dissolved, including 25 rural commercial banks and 15 village banks. Among them, Inner Mongolia Zhenglangqi Huize Village Bank was dissolved and acquired by Ordos Bank. Mingsheng Bank acquired Meihekou Mingsheng Village Bank and established a branch. Dongguan Rural Commercial Bank also absorbed Huizhou Zhongkai Dongying Village Bank and Dongguan Dalang Dongying Village Bank. Especially recently, Liaoning Rural Commercial Bank has been approved to absorb and merge 36 small and medium rural bank institutions. At the end of May, the Rural, Small, and Medium-Sized Bank Supervision Department of the China Banking and Insurance Regulatory Commission published a signed article stating its intention to promote the reform and risk reduction of rural, small, and medium-sized banks. Specific measures include promoting the merger and restructuring of rural, small, and medium-sized banks and reducing the number and hierarchy of rural, small, and medium-sized bank institutions, and strengthening centralized and unified management. According to recent disclosures from the China Banking and Insurance Regulatory Commission, at the end of 2023, there were 4,490 financial institution legal entities in the Chinese banking industry. This marks a consecutive 2-year decrease from 2022. Industry insiders predict that by the end of 2024, the list of independent legal entities in the banking and financial industry will further shrink, with rural, small, and medium-sized banks and village banks still accounting for a significant portion. Since the beginning of this year, regulatory authorities have approved the acquisition of over 20 village banks, and more than 10 village banks have undergone transformations through village upgrades and village splits. Additionally, data disclosed by the China Banking and Insurance Regulatory Commission's financial license information shows that in the first 5 months of this year, over 1,200 banking branch institutions nationwide have exited the market, marking a 30% increase compared to the same period last year. Exiting from this market, agricultural commercial banks and rural credit cooperatives account for a significant portion. There are 527 agricultural commercial banks, accounting for 42%, and 266 rural credit cooperatives and their branches, accounting for 21%. Together, they account for the high proportion of 63%. Some agricultural commercial banks have closed their subsidiary branches in batches. In addition, the number of branch institutions exiting the market for state-owned major banks, joint stock banks, city commercial banks, and village banks respectively account for 18%, 7.5%, 6.5%, and 2.7%. Furthermore, 16 foreign banks, 6 policy banks, and 5 rural cooperative bank branches have also exited the market. Meanwhile, the number of newly established banking institutions nationwide is also decreasing. Data released by the Banking Regulatory Bureau shows that a total of only 894 bank branches were established in the first 5 months of 2024. Lo Fei-peng from the China Postal Savings Bank Research Institute commented that the banking industry's net interest margin is at a low level, profitability is declining, which increases the pressure for capital replenishment. Following some branch institutions to exit the market can reduce banks' operating costs. On March 19th, Zhejiang Bank announced its performance forecast, stating that its net profit for 2023 is expected to decrease by not less than 30% year-on-year. According to mainland media reports, Zhejiang Bank's non-performing loan ratio has been rising for 2 consecutive years, increasing 2% in the third quarter of last year, and its provision coverage ratio has been continuously declining. The provision coverage ratio reflects the bank's ability to cover potential loan losses, also known as the adequacy ratio. Enterprise early warning data shows that as of the end of September last year, Zhejiang Bank's non-performing loan balance was 6.8 billion RMB, and the non-performing loan ratio was 2.27%, with a provision coverage ratio of 133%. The Economist reported that Zhejiang Bank rarely informed investors that due to poor loan performance, its profit for 2023 may decrease by 30%, which is typically undisclosed by mainland Chinese banks. The report said that Chinese banks lent bad loans to asset management companies as a way to handle their bad loans. The contracts signed by both parties attempt to avoid purchasing bad loans that may have credit risks, but due to confidentiality clauses, the details of such transactions have not been disclosed to the public, even to the courts. Banks involved in such transactions appear to be addressing their bad debt problems, but in fact, they are concealing the issue of bad debts. Ben Chaoroen Wang, professor at the Department of Finance at the National University of Singapore Business School, assistant professor Rong Tian, and associate professor Miao Meng from the Business of Finance at Renmin University of China, warned that over time, these problem loans will continue to accumulate. For hundreds of banks in China, they are like time bombs waiting to go off.